There are certainly parts of the market that are overvalued. Some of the stocks we like to buy, we're choosing ones we think are undervalued. When you break down the market, though, what we've seen is a real divergence in stocks since mid-March. The reopening trade that was doing so well from fall of last year really moved lower on the COVID Delta variant outbreak, first in India, then in Europe, then here in the US. And if you look at how those have tracked, those have become a lot cheaper. And as we potentially get this Delta variant under control, those become an opportunity. So overall, I would say, the market at first blush looks overvalued, but when you pick and choose, you can really find values. And, when we invest for clients in individual stocks, obviously, that's what we're trying to do for them. But, look at some of those high multiple stocks that did so well last year. We think some of those are overvalued and worth staying away from. But we do see a phase 2 of the reopening coming after Labor Day. So we do think there are some real good opportunities here, whether it's like a Six Flags or a TJ Maxx, that can go into either a balanced strategy for income or a more aggressive growth strategy. So it definitely is time to pick your places very carefully, given some of these valuations.
Okay, TJX, obviously the parent company of TJ Maxx and Six Flags. Those are both consumer plays. I don't know if I want to call them reopening for TJ Maxx, maybe certainly for Six Flags. Doesn't sound like, Joanne, you are that concerned about the consumer, about new lockdowns.
Yeah, I don't think new lockdowns are in our future from everything, the medical professionals are saying. Certainly some countries are using those. But here in the U.S., we have obviously a pandemic now among the unvaccinated, but, a lot of the country is doing just fine with this. I would say that you can still find some good bargains. TJ Maxx actually is a treasure hunting operation. You want to go back into those stores in person to find your gems, your great bargains. But there are a lot of other places to go in this market, even in the tech space, which some people are really looking at as potentially overvalued. The move towards everything online, towards electric vehicles, towards greater factory automation, this is pushing up all of the data that's flowing into the cloud. And so we see a company like Broadcom, for example, as a good opportunity both for a growth strategy and for a balanced strategy because it offers such a nice dividend. But also what we're looking for, Brian, after this, first wave after Labor Day of folks coming back to the market to look for jobs with their kids back in school, with those extra unemployment benefits coming off, we do see then a third phase of reopening as the COVID gets more under control around the world. And we do think this will take some time, given the vaccine rollout is certainly slower outside of the United States. But that third phase suggests that international stocks are really an important place to be also. And so we've added some of those into our all of our strategies, whether it's a company like Taiwan Semi, which we've owned for a long time, but more recently a Walmart de Mexico, for example, to pick up on Latin America's recovery. So it's important, I think, at this point to get some international exposure, to be able to participate in that phase 3 reopening as COVID does get under control around the world.
Yeah, that phase 3 should be hopefully globally emerging countries, those that don't have access to the earlier vaccines. Do you sell some U.S. companies then to start to rotate into Latin America names, as you said, some Asian names, or is it still really specific stocks that you've got to find, whether it's here or whether it's in Mexico?
Yeah, obviously you have to make some room in the portfolio. So, whether that's taking something off the table that's done really well and maybe the valuation's gotten a little steep. But, the way we do it is, as you sort of suggested there, Brian, company by company. We look for good companies, solid balance sheets, good growing end markets, and at a reasonable price. So we have invested more in Latin America, whether it's a stone company or, as I said, Walmart de Mexico, but also China. I know there's been a lot of concerns about the regulatory crackdown, but we've recently added Alibaba, for example, in our growth strategy because we're weighing the risks of further intervention against the growth potential that China as a whole has. And we don't think that the Chinese government is going to want to, kill the goose that lays the golden egg. I mean, that company and Baidu, for example, are really the engines of growth right now in the Chinese economy. And while we may see some more regulatory noise and actions, we do think those are particularly cheap right here and like those for China exposure.